Many thanks to the speaker, Mr. Sabapati. I beg my apology for not giving you the more time. I am sure if we allow more time, he can express the idea in a better way. But we are in a position that we have to complete it within 90 minutes the session. I apologize for another announcement. It should be made in earlier. If you have any question, please write the questions and send it to the dais, and I send the questions to the speakers for answers. Our second topic is sustainable performance management in governmental undertaking. This paper will be presented by Dr. Ashish Bhattacharya. He is the advisor of the Institute of Cost Accountants and as the chairman of the Board of Advanced Studies of the Institute. He is a qualified chartered accountant, cost and management accountant, both from India and SAFA-CMA, UK. He was the professor of the Indian Institute of Management, Calcutta, and the directors of the International Management Institute, Calcutta. May I invite Mr. Bhattacharya to present the paper.
Good afternoon, friends. I thank the organizers for giving me an opportunity to be here, to share my views with you, and to make a presentation of performance management in government sector. Time limit is 20 minutes, so I shall cover within 20 minutes. We are talking about sustainability and corporate responsibility. And we are talking it from the morning because the theme of the particular summit is sustainability and corporate responsibility. As a result, we are looking the same topics from different perspectives. And when we talk about sustainability, we are talking about initiatives to improve the living of this and future generations in a very, very simple manner. That means if I am talking about today what I consume, if I am talking about how well-being I can improve my quality of life, I have also to consider, as we do, in the smallest unit in the society, that is in family, what is happening to the next generation. That is what we are talking about, sustainability. And when we talk about corporate responsibility, naturally we are talking about to operate like a responsible citizen and look beyond creating shareholder value. This is a very, very important aspect when we talk about corporate responsibility. Take an example. Are we really concerned in the corporate that we should try to evolve a mechanism to ensure that the work-life balance of our employees are maintained? Are we concerned about that? Or we feel very happy when we see that my employee is working late hours and perhaps producing with which I am happy, irrespective of whether his family is suffering or not. Now, this is what we talk about the corporate responsibility. Or for example, if we decide to close a particular unit for some economic reasons, are we really looking into whether those who will lose their employment, not in terms of the direct employment, but also in terms of their livelihood as a vendor, whether we are retaining them and trying to establish them? Maybe that my employee was not capable of, because of his age, to acquire new skills, but his next generation might be able to acquire next skills. Am I concerned about that? If not, I am not a responsible company. The question is whether all this, what we are talking here, are embedded in the decision-making process in corporate. If it is not, in that case, we are really not moving towards the sustainability and corporate responsibility aspect which we are discussing from the morning. Second, we are talking about disclosures. I sometimes feel that before we come for the public disclosure, as a company, are we looking at the mirror by introducing that kind of disclosure in our MIS to say that how I look on the parameters that has been suggested, maybe say GRI. If not, am I improving myself? Now that is a very, very important point. That means before you go for public disclosure, are we trying to implement those kind of MIS which will create an atmosphere, a culture within the organization to really understand what is sustainability, what is corporate responsibility, and how I shall be perceived by outsiders when I publish those kind of information in the public domain. It is a long way to go. It is not very easy for us to imbibe what we are talking here today. The reason being, we are in competition. We sell our products in the market. Unless the society ensures that it will buy products and services only from those companies who follow the guidelines which we are talking here, perhaps a company that is following those kind of norms may not remain competitive for the current period. And if I don't survive, where is the question of my long-term perspective? I have to survive today. And therefore, what is important is, while we discuss all these aspects here, we need to go out and create a kind of atmosphere, a awareness among the society who are not directly involved with the industry, with the corporate, to say that create an awareness because sustainability is everyone's responsibility and not the responsibility of corporate only. Now, with these few words, let me go back to my topic, which has been allotted to me. We are talking about the government sector, and we are talking about the performance management or measurement. Now, when we talk about public sector institutions, there are two types. One, when we call public service institutions, where they work towards improving the quality of life of those who are disadvantaged, marginalized, and vulnerable, and they work for social capability building. And therefore, they have no onus to generate surplus. When we talk about public sector enterprises that are engaged in commercial activities, then they need to generate surplus for survival and growth. Now, when we look at these two kind of organizations in the government sector, and when we talk about performance management, we have to keep in mind what are the objectives of performance management. We are talking about an effective performance measurement system provides feedback to the institution to enable it to improve its performance. It enforces accountability. It influences the behavior of managers and directs their attention to key success factors by identifying KPIs and enables benchmarking. These objectives cannot be different for private sector and public sector. They remain the same. And therefore, when we talk about the performance measurement and management together, then we need to keep these principles in mind. Let us first look at the performance measurements in public service institutions. Just now, the speaker has said that we are moving towards new performance management system. We can coin the word that we are moving from public administration to public service management. Earlier, we were talking about public administration, which means that you have a budget, you work within the budget, you report the variance from the budget, and sometimes we also try to measure the output in terms of quantity. For example, when we talk about educational institutions, perhaps we talk about how many educational institutions we have established during this period. Or going to a little bit of the micro sense, we can say that how many students were enrolled within these schools. But we don't talk about the quality or what is the outcome we are talking about. And that is the shift we are looking at when we talk from public administration to public service management. Now, what is the objective? The objective of public service institutions are that not only does the right things, but does them right, that is, more efficiently and effectively, welfare of citizens, and enhance competitiveness of the country. It is very important for us to understand that when we talk about competitiveness, it does not come from the uniqueness of resources available with us. Unless we create social capabilities, the competitiveness cannot enhance. And that is why we require a better corporate governance, a better system for measuring and managing the performance. We have already said that sustainability initiatives are inherent in the operation of public service institutions. They can contribute more towards sustainability if they eliminate waste and focus on outcome and not on output. This is absolutely important. The question is that we talk about sustainability and it is inherent. But if we have to enhance their contribution towards sustainability, they need to cut down, eliminate all kind of waste, and focus should be on outcome and not on output. That means we are talking about shifting away from input-output measurement, rather focusing on the outcome, and outcome only. Now, what are the challenges when we talk about public service institution? Power equation between political institution and service providing institutions, very important. When we talk about performance management in private sector, in contemporary management accounting literature, if you see, it should flow from strategic objectives. That means there must be a strategic objective, and performance measurement system, for example, balanced scorecard, should be built around that objective. Sometimes you will find, because of this power equation, we vaguely articulate the strategic objective, or what we articulate at a political level platform, we don't commit to that. And therefore, absence of that kind of mission or the objective really creates a burden, a constraint in building or establishing the right system for performance management and performance measurement. Relative bargaining power of various stakeholders. Often we talk about that you get what you demand. Now, who are the beneficiaries, the stakeholders when we talk about public service institutions? They are really underprivileged. They are those who does not have bargaining power, and therefore they cannot demand. Of course, democracy gives them a lot of bargaining power. But again, perhaps what they need is not supported by those who have the power or who try to pose that they are leading them or bargaining for them. For example, NGOs or political parties, or even the social institutions. Distance and layers between the policymakers and the recipients of services. This is a huge constraint in developing the right mechanism. Because when it comes through that many layers, because for example, we are talking about some program we have taken in a rural area. Policy is made at the central government level, it goes to the state government level, then comes to Gram Sabha, then to Panchayat. In all those through layers, are we able to really communicate what is the mission or objective, or what is the kind of outcome we are looking forward to? So this is a huge constraint, unlike our performance management and measurement in private sector. Questionable integrity of information because of weak information management system. We are, of course, talking about e-governance, we are talking about accrual system of accounting, but still the information system was weak. Whenever we talk about performance management, it requires collection and analysis of data. Data must be transformed into the right information for the purpose of evaluation of performance. So these are the weaknesses within which we need to develop a performance management system or performance measurement system in public service institutions. Traditional system, very quickly, it focuses on process and inputs, rule-based approaches, input-output measurement, no accountability for outcomes, performance explanation system rather than performance measurement system. Because the bureaucracy always like to explain why it could not perform in terms of input-output, but it does not say that how we have managed the performance, and therefore there is a need for change. When we talk about the new performance management system, we are talking about focus on outcome. Quasi-market mechanism may be applied where user charges are levied. Otherwise, you cannot apply the market mechanism. In case of private sector, of course, we can look at the market mechanism. We can get signals from there to measure the performance, but there is no market-based performance metrics can be evolved when we talk about measurement or the performance or management of the performance of public service institutions. Participation of primary stakeholders in performance evaluation. Now, that is also we are talking about. Of course, in the corporate sector also we are talking about engagement with the stakeholders. And when we talk about engagement, that becomes a very, very important part when you are unable to evolve the objective metrics for evaluating the performance. Emerging tools are two: value for money or performance audit and social audit. When we talk about value for money, that is the kind of audit that is being undertaken by CAG in India. We talk about utility derived from every sum of money spent. And we talk about performance measurement focuses on utility of strategic objective. Now that is very important. Utility or strategic objective, I said that there is a problem in this. Still, today we are trying to develop that kind of objectives set out by the policy-making authority and also on the processes and inputs. I have taken an example from a guidelines issued by the Ireland government. This is just for an example. We can develop this kind from various sectors. For example, when we take the examples from transport sector, there is a program logic and program indicator. A strategic objective in this case, look at it, improved road infrastructure to support economic and social policy in the Northeast. Remember, we are not talking about the output, we are talking about the outcome. Then we are talking about performance indicators are percentage of primary road in the area and regional economic output, employment levels, and average income. Now, these are the indicators to look at whether this strategic objective or the outcome has been achieved. Then we come down to the program objective. We are saying average time taken to travel by road from Dublin to Dundalk reduced to 90 minutes. This is another quantitative measurement we are talking about for the distance to be covered in 90 minutes. Baseline indicator is baseline expected time to travel at a specified time and in a specified condition, that is in different weathers. Then we are talking about inputs. The team involved in the project, the funds allocated and physical inputs, and we are talking about performance indicators, overall cost, value or quantity of materials for road building, value or quantity of labor for road building. Then we come down to activities, planning, design, construction, and maintenance activities. Then we look at whether milestones are met during the construction phase. Now, all these are the consideration we have to see. Then we go to outputs. We say the kilometer motorway actually built, and indicators are number of kilometers built and quality of the road. Then results are reduction in actual average journey time from Dublin to Dundalk, and improvements in journey time, reduction in accidents and road details. But then we are coming to the final measurement where we are talking about the impact. Impact logic is growth in economic activity in the Northeast due to the new road and improvement in social conditions. And indicators are changes in traffic volumes, attraction of new business or tourism in the area, increase in population served. Now look at the whole logic and the performance indicators. We are focusing on the impact, only impact. If we don't focus on impact, let us say that we reduce the output level. In that case, we are missing out. That what is the result? Output might be, we can say that many kilometers road has been built, but whether we are receiving the results or the impact. So it is very important for us, even when we are evaluating or measuring the performance of a public service institution, to focus on the outcome or the impact. If we miss it out, perhaps we are not doing justice of the resources that we invest in creating social capabilities. We shall miss out somewhere. In India, the CAG has taken performance audit. It is the same as value for money audit. It says that performance auditing is an independent assessment or examination of the extent to which an entity, program, or organization operates efficiently, effectively, with due regard to economy. So we are here talking about all three E's: efficiency, effectiveness, and economy. These all three E need to be covered the way we covered in private sector organizations. And when we talk about the components of performance audit based on the guidelines of CAG, it is process evaluation, outcome evaluation, impact assessment, cost-benefit analysis. All need to be covered when we talk about performance audit. Again, we are really focusing on value for money audit. The example we just given on the rail transport of Ireland, same thing is being followed by CAG as well. Then the another tool is social audit. Social audit is not new, really. In 1950s, the concept was being floated, but it has gained momentum now. Social audit is the process that ensures participation of all stakeholders in evaluating the performance of institutions delivering social services. Social audit focuses on outcome and not on output. Social auditing refers to a process through which an organization assesses, reports, and improves upon its social performance and ethical behavior, especially through stakeholder dialogue. The focus or emphasis is on stakeholder dialogue, and stakeholder dialogue. We are also in corporate sector talking about stakeholder engagement. With the same philosophy, we are talking about who will evaluate the beneficiaries, the stakeholders. In India, social audit has gained significance with the evolution of the Panchayati Raj institutions, which are institutions for local self-governance. And in fact, the National Rural Employment Guarantee Act of 2005 mandates the regular conduct of social audit of work sanctioned under MGNREGA, that means Employment Generating Guarantee Act, in the Gram Sabha at least once every 6 weeks. Gram Sabha is just above the panchayats. And Gram Sabha really conduct the social audit involving all the stakeholders. That is why what we are talking about, that even when we are talking about evolving a new performance management and measurement system, these kind of new tools need to be used. Involvement of the stakeholders is absolutely important, and focus on outcome or the impact is very, very important if we see that the resources are optimally used and results are being achieved. Now, those which are engaged in commercial organizations, commercial initiatives, let us look at the history in India. Initially, they were, that means public sector enterprises, were created to support capital formation, both financial and human, and to bring social economic transformation. Now, their core objective function is to create shareholder value, a shift, because we cannot say that this kind of institution can be a burden on the government. And that is why the focus has now been shifted from creating bringing socio-economic transformation to creating shareholder value. With this background, we can say that PSEs are engaged in commercial activities. As a result of this investment program, some of them are listed. Creating shareholder value is the core objective. However, they are also used as instruments to achieve certain social goals. Now, the last point is also important. Although we are talking about that they are listed, for example, the banks. Bank often we used in India to provide certain kind of loan to priority sectors. Sometimes we use the bank as a leader to bring about a change in the banking sector itself. Similarly, when we talk about other kind of, for example, oil marketing companies, they are also being used for energy security for India. Therefore, we cannot say that while the core objective is creating shareholder value, we have shifted fully from the initial objective of creating social capital. Now, there is a system of MOU in the PSE evaluation. Just 2 minutes. In PSE evaluation, MOU is mutually negotiated agreement. Government and public sector sit together. There is a whole mechanism by which you enter into a memorandum of understanding. It aims to providing greater autonomy to public sector enterprises and a level playing field vis-a-vis the private sector. Now remember the line in between. We are talking about that it is the level playing field with private sector. That means we are saying that you will be evaluated as an organization, enterprise in the private sector. Then the management of the enterprise is made accountable to the government through the promise of performance contract. This is the MOU system which is evolved and working well in India. Equivalent weights are assigned to both financial and non-financial parameters. The non-financial parameters are further subdivided into dynamic parameters, enterprise-specific parameters, and sector-specific parameters, whereas the static or financial parameters generally relate to profit, so and so, size of productivity. The dynamic parameters refer to project implementation, investment in R&D, and the extent of globalization, etc., etc. Non-financial parameters, the choice of individual non-financial parameters constituting 50% of weight is left to the combined wisdom of the CPSC, because it is specific to the CPSC, unique to the CPSC, the state at which CPSC is there, and administrative ministry and task force. Sector-specific parameters really look into the macroeconomic factors. Enterprise-specific parameters relate to issues such as safety and pollution, etc., etc. Now, when we talk about CSR and sustainable development, I have quoted from the government document on MOU. It says the corporate social responsibility is a concept whereby organizations serve the interest of society by taking responsibility for impact of their activities on customers, employees, shareholders, communities, and the environment in all aspects of their operation. It says corporate social responsibility is companies' commitment to operate in an economically, socially, and environmentally sustainable manner while recognizing the interest of its stakeholder. This commitment is beyond statutory requirements. That means government is trying to create or trying to persuade the public sector enterprises to be the leader in taking initiative in CSR and sustainable development. Now, corporate social responsibility, R&D, and sustainable development were included in non-financial parameters with a mandatory weight of 5% for each. Now, when we talk about MOU, there are a large number of parameters. Total marks is 100, and a company is evaluated at the end of the year based on how much marks could be assigned to him based on the performance. So out of 100, 5% is given to CSR, and 5% is given to the sustainable development initiatives. The Ministry of Corporate Affairs has issued a guideline on social, environment, and economic responsibility of companies. Implementation of the same is monitored by the board of directors of PSCs and the government. Now, the whole question is, when we are talking about PSCs, we are talking about sustainable development, CSR, we are talking about their social, environmental, and economic responsibilities. We need to change further. We have just initiated, but the question is how to internalize it. For example, when we talk about the corporate responsibility, although we talk about setting the tone at the top, but has it articulated at the down level? Because decisions are taken not always by the managing director, but decisions are also taken by the manager's lower level. So the moot question is that how can we articulate the philosophy of CSR and sustainable development to the down level, to the lowest level employee within the organization? If we can't do that, all we discuss in this kind of environment will be fruitless. Or in other words, I can say that it is not really meaningless or fruitless, but the progress will be a bit slow. And therefore, we have to ensure if you are a member of the board or if you are in the top organization, whatsoever is our position as an accountant, as a management accountant, to tell the industry that how to articulate all this to the down level, to the last employee within the organization. Thank you, friends.
Many thanks to the speakers, Dr. Ashish Bhattacharya, for his nice presentation. Accounting and the Fiscal Sustainability Reporting. This paper will be presented by Mr. Alan Edward. Mr. Alan Edward is International Director and CFO of CIPFA. He is an experienced public sector board member, being an independent member of the board of the UK National Policing Improvement Agency. Most of his career has been spent as a management consultant, having been a consulting partner at PwC, KPMG, and IBM. He trained as an accountant in local governments in the UK and has long been an active CIPFA member, including being in the past as elected members. May I request Mr. Alan Edwards to deliver his speech.
Ladies and gentlemen, thank you very much. If I could just thank SAFA and CMA Sri Lanka for inviting me to talk to you today. That's been a very professional conference you've put together, and I really welcome the chance to talk to you. Today I want to talk about government fiscal sustainability and the current sovereign debt crisis. I want to talk about why that raises major issues for us in public financial management and what we as accountants and professional accounting organisations should do about it, and in particular why I believe we need to create a global public financial management profession. I'm going to start, if I may, with a few words about CIPFA, the Chartered Institute of Public Finance and Accountancy. It's the only body in the world that focuses on public financial management and public governance. We're a long-standing body. We celebrated our 125th birthday a couple of years ago. We're a founder member of IFAC. We're a very unusual body. We're a charity because of our public sector focus. But in the UK, we set standards for accounting, audit and governance in the public sector. and we advise IFAC on public sector standards. We work internationally on capacity building and on training, mainly working very closely with other professional accountancy organisations. I'm going to start with a few words, if I may, about the sovereign debt crisis. Colleagues, there isn't a day that goes by without a comment in our press, and I'm sure in your press, about the sovereign debt crisis. In the UK, our newspapers are full of gloom about a potential lost decade of growth. And overnight, the IMF gave a very clear warning about the potential breakdown of the euro. And in that event, colleagues, we are frankly bound to see another global recession that is going to impact on all of us. Governments around the world are facing unprecedented pressure on their finances, and as the slide shows, the domino effect, because this effectively started with Greece, we know, but is now affecting very large economies in Europe, in particular Spain and Italy. Bailing out the banks in 2008 has increased debt levels around the world to what many people now believe is an unsustainable level, in excess in many countries these days of 100% of their GDP. There is enormous pressure on governments, on the one hand, to invest, stimulate growth, protect jobs, and on the other hand, to cut back and embrace austerity. Meanwhile, of course, government revenue is falling as tax revenues decline in the current recession. And as we see all around the world, particularly in the world's largest economy in the US, there is no appetite for additional tax revenue. Colleagues, this is a recipe for a further deterioration in government finances. But what has this got to do with public financial management, you may say? Well, one of the issues that is worrying for all of us is that, frankly, one of the major causes of this